Long-term equity investments, the equity method. This is used when you own or invest in a company and own between 20 to 50% of the company's outstanding voting stock. And it's used because you have a interest that is able to influence the decisions of the company. And that's the underlying thought process that goes behind this method. So let's take a look. So if you own between 20 and 50%, you have influence. And so the investment is recorded at its original cost, but at year end, you take a proportion of the net income or the net loss as your own. So whatever your percentage ownership, you take that percentage times the company's net income or net loss, and you include it on your income statement as your income because you influence the happening of it. It also increases the investment in equity investment account as well. Dividends, since you also probably were on the board and part of the decision whether to declare a dividend or not, are treated as a reduction of your investment account. They're not dividend income. The investment is not marked to the market value, but you disclose it in the footnotes. If there's goodwill, it's not amortized or evaluated for impairment. It's just included in the investment account. And if more than 20% of the equity does not result in significant influence, meaning there's a lot of other shareholders as well, the investment should not be accounted for by the equity method, but using available for sale or the mark-to-market method instead. The reason is this is used if you have influence over the company you have invested in. Here are the entries that are involved. So when you buy, you're going to debit the long-term investment, credit cash for whatever you pay for it. When a dividend is declared, you're going to debit dividend receivable and credit long-term investment. Notice no dividend income. When the dividend is paid, you debit cash, credit the dividend receivable. And then at year end, you're going to take a portion of the company's net income and multiply it by your proportion ownership and increase your long-term investment account and also credit equity income, which is a revenue account on your books. If you follow this for the next year, here's the dividend is declared, the dividend is paid, and then at the end of the year, notice in the second year in 2018, you had a net loss, so you can see that reduces your long-term investment account in that company. Here's an example where you own between 20 and 50%. It says that they purchased 10,000 shares of Riley. So here's the entry to purchase, debit investment in equity securities for $190,000, credit cash. It then says the investment represents 25% of Riley's outstanding common stock, and they're going to hold this investment indefinitely, meaning it's a long term. During the year, the Riley earned a net income of $75,000. So at year end, you're going to take 25% of $75,000 as your own income because you had influence in earning it. So you debit investment in equity securities, credit income from equity securities for 25% of Riley's net income. In addition, it said that in both years, dividends are paid at $1.50 a share. You own 10,000 shares. So this is your dividends, debit cash, credit investment in equity securities. Remember again, no dividend income under the equity method. In the following year, there was a loss of $6,000. So if I take 25% of that, I'm going to debit loss from equity securities. That shows up on the income statement, and credit investment in equity securities, which is the asset account, and it is reduced because there was a loss. And then the second entry has to do with the dividends that were declared and paid. Debit cash, credit investment in equity securities. I can also show it in the T account so that I can see at the end of the second year I have a balance in that account of $177,250. In Part B, they want to know what the book value is. Well, you compute book value by taking the balance in the investment account and dividing it by the number of shares. So in the first year, 193,750 divided by 10,000 shares is $19.37.5. In the second year, 177,250 divided by 10,000 shares, the book value is $17.72.5. So that's the equity method. And this is another one that has a little twist to it. So we're given the long-term investment in equity securities, beginning and ending balance, which I can then do a T account and see what happened. I'm also told that my income from equity securities for this year is $12,000. So I take my beginning of 25, add to it my net income, and say, wow, there must have been some dividends. So I can see that the dividends that were declared and paid, my portion of them was $8,000 to come up with the ending balance in the investment in equity securities. Because of that, in Part A, they ask how much net income did this company that we own 30% of, what was its total net income? Well, if 12,000 was our portion and we own 30%, if we take 12,000 divided by 30%, we can see that the total net income for the year for Tumbleweed is $40,000. In Part B, it says what was the dollar amount of the total dividend declared, not just our portion, but the total. Well, our portion, excuse me, our portion was $8,000. Again, divide by 30%, and you can see that the total dividend declared was $26,667. And they asked for the journal entries regarding this. So the first one is to recognize the income, our portion, the 30% portion of net income from Tumbleweed for Mainmont. And the second one is to recognize the dividends that were declared and paid. To recap, the cost method has a balance sheet long-term investment account. It's increased when I buy, it's decreased when I sell, and that is kept at cost. On the income statement, you'll find dividend income, and you'll also find gains or losses from the sale of securities under the cost method. Under the equity method, it's sometimes known as one-line consolidation because on the balance sheet there's one line called investment in equity securities. It's increased when I buy, and each year the proportion of the net income that is attributed to us each year. It is decreased by our portion of the dividends declared and paid. It will also be decreased if I was to sell this investment. It's also one line on the income statement called income from investment in equity securities, where the percentage of the net income attributed to us is included as a revenue item or as a loss item due to our involvement. This is a nice recap of everything we've talked about. Basically, you have a couple questions. Is it marketable or not? If it's not marketable, generally it's the cost method. The second thing is it a current asset or a long-term asset? And then what amount do we own of it to give us the different treatments? Whether it's trading securities available for sale, equity, consolidation, which we'll talk about next, or the cost or equity method. All right, so I own a company and I own 50%, let's say. And when we look at this, we have the big company, the megabucks, and the tiny company. And under the equity method, what would show up on the megabucks would be investment in tiny company. One line on the balance sheet, one line on the income statement, income from investment in tiny. So that would be one way. The other way would be if we owned more than, or megabucks own more than 50% of tiny, at which point we would consolidate, which means we would roll both balance sheets into one and call it megabucks consolidated balance sheet. So let's take a look at how that looks. So what happens is the shareholders' equity section of tiny goes away and is offset against the assets. So the assets here are made up of the 50,000 of megabucks assets plus the tiny assets of 20,000 minus the shareholders' equity of 5. So this is 20,000 minus 5, which is their she, for tiny, plus the 50,000 for megabucks. So that's where the 65 came from. When you consolidate, your bills are my bills, so liabilities are just added together. So we have the 20,000 liabilities of megabucks plus the 15,000 of liabilities of tiny. So one reason why you may not want to have 50% control is if the smaller company, that is, you would be consolidating, has a lot of debt, you may not want to consolidate it, and by doing one line consolidation or the equity method, then those liabilities do not show up. And the shareholders' equity is basically, this is megabucks she, because tiny's shareholders' equity has been absorbed. So the point they're trying to make here is that consolidating financial statements can weaken a company's ratios. So if you're looking at financial analysis, you may not want to own more than 50% because then you would have to consolidate the debt as well. So a lot of times companies will just use the equity method to avoid the control over those liabilities and have an improved financial ratios. So how do you consolidate? Well, during the year, the investor, or the one company that has invested in the other company, will have one line on its books called investment in X company. And that stays there for the year, but then at the end of the year, you put them together so that the assets and the liabilities are combined and you eliminate any redundancies. Now, if you don't own 100% of that subsidiary, then you're going to have something called minority interest. And minority interest used to show up as a liability, meaning a responsibility, on the balance sheet. It has shifted in place, and now minority interest, like we saw in Coca-Cola, is now down in the shareholders' equity section. Income from the investee company under the equity method. Remember, you have one line. When you consolidate, you mush all the income together and it loses the my part, your part, because it becomes our part. So the income eliminates any intercompany sales, anything like that. So it's just to the outside of the parent subsidiary relationship. And of course, goodwill we look at every year for impairment.